Hello, everybody, and welcome to our virtual tax school webinar series. My name is Amar Medic, and I am the product marketing manager for TaxWise. To help get you started for this tax season ahead, the topic that we'll be covering today is how to maximize Schedule C deductions for your clients. Our team will share some tips and tricks on how to get the most out of your clients' returns to help you keep your business going strong into the next year. Keep in mind that we try to host one webinar per month, so please be sure to join us in the future as well if you do find today's webinar to be informative. During the webinar, you'll be able to submit questions to the team and get those answered live via polling questions that will pop up on your screen, so please be sure to participate in those. And with that said, I am very pleased to introduce our speaker for today, Mr. Ryan Hubbs. He is a CPA and solutions architect here at Wolters Kluwer, and he has years of experience working in the tax industry. He'll be sharing his insights on how you can maximize Schedule C deductions for your clients. So with that, let's get this started. Ryan, if you don't mind, take over.
Thank you. Thank you so much for the kind introduction, Omar. Very excited today to be hosting this virtual tax school. And it's going to be my goal to give you a lot of tips and tricks on how you can really add some value to your firm and really help your customers with their tax deductions. And just a brief background on myself before we get rolling into the meat of this presentation. My name is Ryan Hubbs, and I did go to school for an accounting. I went to school at Radford University, very small school in the Appalachian Mountains. But once I graduated with my degree, I moved up to Washington, D.C., and I worked for two separate firms there, and I spent almost 10 years working there. And I come from a very broad and diverse background as far as accounting goes and as far as doing taxes go. I did mostly 1040 returns, but sprinkled into that mix, did work with business clients, and given that it is DC, there are a lot of 990 nonprofits. So I've kind of been a little bit all over the place, but I always enjoyed doing personal returns the most, always enjoyed meeting with my clients and giving that extra effort in order to really help them maximize their deductions on their tax return. Currently, I'm a solution architect working for Wolters Kluwer, and it's my job to know all of the different programs, all of the different solutions, and match our clients up with what is going to be the best option available to them. And what we're going to be getting into today, specifically the Schedule C, is we're going to start off with the basics, and then we're going to start working our way up to more advanced and more advanced areas. So we're going to start off very simple. We're going to start off with identifying if a taxpayer is eligible to file a Schedule C. Then we're going to go into something a little bit more advanced. We're going to talk about the gray areas. And, the tax code is always going to say one thing, but there's always going to be exceptions. There's always going to be times that you're unsure. And this is really where your professional knowledge is going to come in to help your clients get the biggest deduction possible. After that, we're going to be going over vehicle expenses, understanding the difference between the mileage rate versus the actual expense method. And we'll go over the pros and cons, and typically when you're going to want to use either method. Lastly, we will be going over our Answer Connect package, which is going to be a great authoritative research tool in order to really help you solve any problems that you may have when it does come to gray areas. It's impossible to know everything about the tax code. It's just so vast. There are so many pages, and having some authoritative research to help guide you on your path is always a good place to start, whether you are a person who's just maybe thinking about getting into preparing taxes, or if you're very, very seasoned, you have many busy seasons under your belt, but you're always looking to stay sharp on your skills. And then lastly, we will be using practical examples using a tax prep software. In this case, it is going to be our TaxWise solution. So with all that being said, let's really jump into the presentation and start off with the basics here. Let's identify who is going to be filing a Schedule C. Well, there's a couple qualifications that your clients are going to have to meet. The primary activity of their business is going to be to generate revenue, to generate money. They should be doing this on a semi-consistent, almost day in, day out basis with that intent of making money. It's also going to be very important to understand what kind of entity is your customer. If they have already filed to become a 1065 partnership, or they're a corporation with multiple members, it's not going to be applicable to file that on a Schedule C. You're actually going to have to go into those specific business returns in order to report their income and to also report any deductions that they may have, as well as to file the taxes. Now, another item is a business that is not a hobby. And this is like one of the first gray areas that we can get into. It's not always clear, but if you go back to points 1 and 2, and you think about, okay, are they really trying to make money? Or maybe I just know someone and they really enjoy carpentry and they make a few pieces of furniture a year, maybe they sell it to a friend, but it's not really how they're supporting themselves. They're not really trying to generate a profit. This is more of a hobby activity that they do because they enjoy it. And they just make a little bit of money on the side. This income would still need to be reported, but it's not going to be reported here on the Schedule C. Now, some common questions that I get from customers and clients is, well, I run a lot of side businesses. I might be driving Uber one day, I might be doing some plumbing the next day. Can I file all that on one form, one Schedule C? And the answer to that is going to be no. There needs to be a clear delineation between your different activities that you're using to generate revenue, that you're generating money from. And so it may be a little bit extra work for them to keep all those records straight, and hopefully they are keeping them straight. We all have clients that don't, but you are going to have to file those multiple Schedule Cs. And the other common misconception that I hear is, well, I just have a business with a tiny amount of income. I don't need to file those taxes. I don't need to file my Schedule C. And the example that we're going to be going over today is going to be Danny the plumber. Now, Danny the plumber was someone that I actually did live with. I have taken some artistic liberties with how I'm going to portray his accounting and tax habits today. But I think you're going to be able to relate to him because he's going to remind you of some of your clients. He's going to remind you of your clients that don't keep good financial information. They're not keeping receipts. There's not a delineation between personal and business expenses. What Danny the plumber would always tell me is, well, I only made a little bit of money, so I don't have to file a tax return. And that is going to be absolutely false. And even if you find just a little bit of money, or even if you may generate just a little bit of money, you're always going to have to report that to the IRS. So with all that being said, I do want to open this up to the first polling question here. And it's going to be, if you find $20 on the ground, it's your lucky day, you're walking down the sidewalk, and you find this money, does it need to be reported as income? And I will give you all just a couple seconds to go ahead and answer this question. And if you're not sure, I know that we have some people in here that maybe they're just looking at getting their feet wet with tax preparation. Maybe you're not quite sure if you're going to do it yet. It's okay to say you're not sure. We're not going to send this off to anybody. We just want to make sure that y'all are engaged and that you are giving your feedback here. Okay, and could we go and close the poll? And could you give me the results?
Yeah, about 73% said no, 15% said yes, and 12% said not sure.
Okay, so thank you so much. So actually, if you find $20 on the ground, according to the IRS, this is technically supposed to be reported as income. Now, this is also another gray area that we could talk about. Are your customers, are your clients actually going to tell you that they found this $20, and are they actually going to report it? That may be a topic for another webinar, maybe an ethics webinar. But you would technically have to do this. And if your customers are the ones telling you, hey, I found some money or I inherited some money, that's going to be your heads up that in order to do your due diligence, in order to make sure that you are giving them the best possible financial advice, they technically should report this. I know sometimes how it operates in real world and how it's supposed to can be two separate things, but technically this is reportable income. The next area that I want to get into is I actually want to focus on some of these gray areas. When I was a young professional, first coming out of school and working for an accounting office, doing a lot of tax returns, I just wanted to get the returns done as efficiently as possible. I didn't want any hiccups. I didn't want to spend a lot of time researching different items because, you get based a lot of times off your efficiency, especially in this profession. The more returns you can get done, the more money you're going to make. But over time, I came to realize that these gray areas are actually extremely important for us. And the reason they're so important is that if doing your taxes was easy, no one would hire us to do it for them. They could just go, simply use something like TurboTax or any product like that, and that's how they would go and do it. But doing your taxes is difficult. The tax law is extremely complicated, and it's knowing these gray areas and having the tools in order to be able to solve them and increase their deductions, and knowing all the little tricks and tips that's really the reason that we're getting paid to do this. We need to make sure that we are well versed in some of these different areas. So the first example, well, first let's start off with some of the deduction qualifications. So we're going to look at travel expenses. This is going to be our first scenario. And so for the item to be deductible, there's a few things that need to occur. One, you need to leave your taxing. And it's a common misconception that just leaving your home for any sort of travel is going to be deductible. I used to work in DC, and if you know anything about Washington, DC, Virginia, and Maryland, they kind of border it, it's very close. And I had a customer who lived in Virginia, and he normally had about a 30-minute commute to his office, but he went to a conference. He went to a conference out in Maryland, but that was also only a 30-minute commute. So even though he left his house, it's still matching his normal routine throughout the day. It's still matching what he would normally do on any given day. So that is not going to qualify. So it is a little bit more advanced than just saying, I left my house. This is going to be a travel expense. You really need to be looking for something abnormal that wouldn't count as a commute. The next thing is it needs to be a trip that is going to be planned in advance. If you have a customer and maybe they're heading out to Austin, Texas to catch a great concert, and while they're out there, spur of the moment, they say, you know what, I got a client out here. I'm going to go ahead and throw on a quick 30-minute meeting, and I'm going to deduct the entire travel expense since I did one meeting haphazardly with a customer. That is not going to fly when preparing these returns. They need to plan out this trip in advance, and the trip is going to need to have a clear business purpose. Now, we're going to get into a situation where when you mix a working trip with maybe a vacation, some fun time as well, there are going to be ways that you can kind of piggyback some of those deductions all together, but it does need to be a trip that is going to be planned in advance. Also, the trip needs to be ordinary and necessary. This just simply means it can't be outside of their normal course of business activities. And lastly, the trip must consist of mostly business. Please remember that word, mostly business. So with all that being said, I actually want to go ahead and look at a scenario here. In this scenario, we're going to have a domestic traveler. This is within the United States. We're going to be looking specifically at the lodging expenses. And I've gone and we've made a little itinerary here for our sample traveler. Thursday, they are traveling to Florida. Friday, they're going to have all day, they're going to meet with clients. Saturday and Sunday, they're going to hang out with the family, do a little vacation time, Disneyland, Universal Studios, etc. Now back on Monday, going to be meeting with clients again. And then on Tuesday, they're going to travel back home. Now, your customer wants to go and deduct all of the lodging expense for this entire week, including Saturday and Sunday when no business activity was done. Let's go back to our previous slide. We can see that your trip must consist of mostly business. And so when we go back to our itinerary, we can see there was 2 days of meetings, there was 2 days of fun time, and there was 2 days of travel. So is that going to consist of mostly business? And the answer to that question is going to be yes. This is actually going to qualify. All of this is going to qualify for lodging expenses. And the reason for this is a couple. First off being your travel days can count as business days. When he's traveling out to Florida, he is traveling home, that's going to be outside of his normal commute. He's taking the extra step. Maybe he got on a plane or he got on a train, and that is going to count as a work-related day when it comes to calculating the travel expenses. Second thing is, and this is a very common schedule that you should know about, this is called a weekend sandwich. And what a weekend sandwich is where you have a travel day, you meet, you have your fun on the weekend, you have another meeting, and then you travel home. And it's very important that you follow this format, the weekend sandwich format, because in order for all of this to be eligible to be deducted on their Schedule C, you need to start the trip with business, and you need to end the trip with business. Now, if there is some free time in the middle and you're still doing mostly business, you are going to be able to deduct that Saturday and that Sunday for any lodging expenses that we have. Now, let's move into a little bit more complicated of a scenario. And for this scenario, we are going to be looking at international travel. And instead of looking at the lodging expenses, we're going to be looking specifically at the traveling expenses. And in this example, we're going to have our customer. They're traveling out to England on Thursday. On Friday, they're going to meet with their clients. and then they're taking the rest of that time, Saturday, Sunday, Monday, vacation day, vacation day, vacation day, then lastly, they're going to travel home. Now, would this qualify for business? Well, we can see that this is not mostly business. However, the rules are going to change when you are doing international travel. The mostly business is a 50% threshold for domestic. However, for international travel, you just need to be doing business at least 25% of the time. So based off this criteria, they're going to be able to deduct all of the travel expenses to get to and from England in this case. Now, if you do run into a scenario with international travel where they are maybe only doing business 10% of the time or 20% of the time, there are still going to be deductions available to them. And what they're going to have to do, or what you're going to have to do, is you're going to have to go in and you're going to have to use that percentage split. So if they only did business 10% of the time, they're going to be able to deduct 10% of the travel expenses. And these two formats are going to be very important for you to know. We work in a field where we typically only see our customers probably once a year. They're going to bring their documents to us. We may get a face-to-face meeting. And when we're going through, we need to make notes and let them know and educate them. This is the proper way you need to take your travel expenses if you do want vacation. These are the ways where you can, lump in some of your personal expenses into your Schedule C legally with no problem. And I guarantee you that if you explain these tips, these tricks on when it comes to travel, it's going to make your customers very happy with you. They're going to know that you're really adding value to their life. You're giving them some free time, some extra deductions when they're just going out and they're just going to have fun. Also, I do want to note, let's go ahead and jump into TaxWise real quick here. And it looks like I need to log back in. So give me 1 second. Log into TaxWise, and we're actually going to be going through a Schedule C today, and we're going to be going line item by line item and filling out some of these items that we have, and we're going to see how this affects Danny the plumber's return. So let me jump into this return. I'm going to load up on the main information worksheet here. I've already pre-entered in some of this information. We're actually going to jump right to the first page of the Schedule C, and let's go ahead and say Danny has $60,000 of wages, and we actually have a refund calculator right here. So right now he currently owes just over $7,000. He's not going to be too happy about that, but we're going to have some good tips and tricks in order to get this number down significantly. Let's scroll down here to our travel expenses, and we're going to say he had $5,000 in travel for his vacation. There also should be noted that the meals that he takes deducted at a 50% rate. There are certain scenarios when it may be more, but typically you're going to be running into that 50% rate. And a common question that I get is, well, do I get to deduct my meals on the travel day? Well, since that is considered a business day, that we're doing business to travel, it's necessary in your course of business, you can also deduct 50% of those meals as well. We're going to go ahead in this case and say there was $1,000 in meals. It looks like we've got Danny's return down to $6,400. So we're starting to whittle away and chip away at this amount too. Next area that I want to go into is, let's talk about our second gray area number 2. And that's going to be interest when it pertains to loans and credit cards. And there are going to be specific areas that need to be met in order to qualify for this deduction. So let's go ahead and look at what some of those are. First off, being the taxpayer is legally liable for the debt. This is going to be probably your clearest delineation if this is going to be available to be deducted by them. If they were to default on the debt, are they going to have to deal with the recourse that is going to be associated with that? Second item being, both the taxpayer and lender intend for the debt to be repaid. I one time gave a loan out to a friend, gave him $1,000, and I told him, if you can get back on your feet, go ahead, pay me back. But if you're just having a hard time, don't worry about it. And when you have that kind of lender relationship, that's not a true loan. I'm saying just do it if you can, but I'm not really expecting it to get paid back. That would technically be reported as a gift. And there are not going to be, even if he does go and repay that loan, since it is a gift, he's not going to be able to deduct any of the interest from that loan that I was giving him. And then the last item being here, you need a true debtor-creditor relationship. This kind of piggybacks on the prior point that I was making, but you just really emphasizing the point here that you really need to have that relationship where if there is a default on the loan, that you are expecting there to be repercussions and acts taken in order to recoup some of those losses. And I have an example here for us today, and I want you to go ahead and think about this, and we'll launch a polling question here in 1 second. But the example is going to be a son wants to start a business, and his parents are going to go ahead, they're going to take out a second mortgage on their home, and they're going to give that money to their son in order to start a business. Now, in return for that, the son, he is going to make the payments back, and he's also going to make the interest on those mortgage payments back. Is this going to be a deductible expense on the Schedule C? Let's go ahead, let's open this up to a polling question. We'll give you all 30 seconds here to go ahead and get your answers in. And I want you to go ahead and think about some of those areas I was talking about. I want you to think about who's legally liable for the loan. Is this a true relationship? I'll let you know in this case, the parents are expecting him to pay them back, but are the other criteria being met? Okay, and could we get the results of that, please?
Yeah, answers still trickling in. Let's give them a few seconds.
Couple more seconds, that sounds good.
Yeah. So we got about 64% of votes in, and so far it's 50% saying no, 35% saying yes, and 15% saying not sure.
Okay, good. That's a good breakdown. So if we go back, and we'll go back to the previous slide here, I want you to focus on, is the taxpayer legally liable for the debt? Well, in this scenario, who took out the loan or who took out the mortgage? The parents. The parents are technically the people who are legally liable for that debt. Even though the son is going back and he's making the mortgage payments, including the interest, if there happened to be a default on that loan, it's going to come back to the parents. They're going to be the ones ultimately responsible for dealing with the consequences of that default. So in this scenario, no, it's not going to be deductible. I will give you one caveat, and this is probably something that you should hang on to in case you do have any clients that are thinking about doing something like this. If the parents and the son were to go ahead and make a legally binding contract, the terms of the loan, and what he's going to repay, what the interest is going to be, repercussions for if this loan is not repaid. If all of those criteria are met, then you could deduct it as a Schedule C. But in my experience working with my different customers, that I find that to be extremely rare. I find it to be extremely rare, and it's mostly treated as more of a gift, or is treated as the taxpayer not being the person legally liable. So the answer is no. There are a few caveats though, which maybe you're thinking a little bit ahead. That is how that is going to work. Next item, I want to bring up another example here, and don't worry, there's not going to be a polling question on this one, is example number 2. Let's say the taxpayer goes to a bank, and they're giving a lump sum to go ahead and start a business, but included in this lump sum, there is going to be living expenses for them to live for 1 year. Well, is the interest going to be deductible in this case? And the answer is going to be some of it. It's going to be partially deductible. And what you're going to need to do, and it's really what they're going to need to do, is they really need to keep accurate records in this case, because any of the business expenses, any of the interest on the business portion, you'll have to kind of figure out the ratio, the percentage. Anything relating to the business is going to be able to be deducted. However, all of those living expenses are not included in starting up a business. If I were to go and start up a business and live off, my savings for a year, I'm not going to be able to deduct my rent. I'm not going to be able to deduct any meals that I may have. So there needs to be a clear delineation. If you ever do run into any situations like this, this would be a client that I would sit down and talk to and really stress to them that they need to keep accurate records. It would probably be in their best interest to get an accounting program in order to do their bookkeeping. And the main primary reason for that is if they get audited, it can be very, very difficult in order to delineate what expenses occurred where and find that actual percentage. So this would be a high-risk client that I would definitely recommend keep really good receipts of, and really good accounting records of. Moving forward from this, I want to talk about bank fees and credit cards. Now, you all probably know that your annual, monthly transfer fees, even your overdraft fees for your business can be deducted if it is for your company. If it is going to be for a personal account, that's when you cannot make those deductions. And the reason I want to bring this up is thinking back to Danny the plumber here. You know, he had a business card, had his business name on it and everything, but did he just use it for buying materials, buying gas for his truck? No, absolutely not. There was not a clear delineation between what was a business expense and what was a personal expense. And he did lose out on some of these deductions, but also what happened was when he got audited by the IRS, all of his accounts were, or all of his billing was just on one credit card. And that's not technically wrong, but when he had to go back and go through literally years of bank statements and trying to figure out what was what and separate them between business expenses and personal expenses, it was a complete nightmare. It took weeks upon weeks in order for him to do this. And if you can also get your clients to really adhere to having this clear separation between the two credit cards, between the business and the personal, if you do happen to be doing any bookkeeping as well, going to make your life a lot easier. Something I would definitely recommend talking to your customers about, is it really helps minimize the unknown when it might come to being audited. One thing about our customers that they don't always understand about our profession is, you know, they're giving us $300–400 to do a tax return, and they just assume it's impossible for them to get audited and that everything is always going to work out. But what the best we can do as preparers is make sure that we are giving them the best financial advice that we can, and that they are going to, you know, hopefully follow that advice. They're not always going to do it, but you want to put them in a situation where if anything does go sideways, or there are any issues that may be arising, that you're really putting them in a position of strength when it comes to dealing with the IRS. So always recommend having that clear delineation. It's going to save you and your customers a lot of heartache in the long run. Next gray area that I want to get into today is going to relate to advertising expenses. Now, advertising can be fairly straightforward. It can be fairly simple. We can look at some of the common types of advertising, you know, print, online ads, radio, billboards, banners. You know, that's a pretty easy item. That's not a gray area. That's going to be a common item. But there are certain situations that you might run into where you're not quite sure. And what our instructions are from the IRS is that you can usually deduct advertising, keep your name before the public if it relates to your business. So let's go ahead and look at some of these more complicated examples. Example one, launching a new website. Well, if we go back and we think about it, it needs to keep your name before the public if it relates to your business. Launching a new website is absolutely deductible as an advertising expense. This is going to be a place where people go to learn more about you. Second item, hiring someone to design a business logo. This gets a little more gray, as you're not really developing this logo with the intent of, you know, taking out a specific ad just to display your logo. But the IRS is very clear here. You can deduct the design of the business logo. And then lastly, we have sponsoring a political campaign event. Maybe you have a customer and, you know, they don't even care who the parties are. They don't care who wins, but they're getting a great deal on some advertising. They're going to give them some money in order to place up some banners, and they're planning on taking that deduction on their Schedule C. Well, let's go ahead and take a look at what we need to qualify here. We need to keep your name before the public if it relates to your business. This is clearly doing that when you're going and you know, sponsoring a political event. However, the key word to all this is going to be usually. You can usually deduct advertising if it does this. And the IRS is very clear that if this is any way corresponding to a political event, you cannot take the deduction. And that's one of the things about this profession, where even if you know all the wordage, even if you know exactly what it says, there will always be exceptions. There will always be loopholes. And it's really learning what those are going to be that's going to make you the best preparer you possibly can and really help give you the most value back to your customers. You could bring them in for an amount of time and you're gonna be able to say, look, you need to stop doing these types of sponsoring events. These are not deductible. This is just money out the door. We need to really focus on events where we're going to be able to take these deductions. So, all that being said, I actually want to go and jump back into TaxWise. And let's go back to our Schedule C and start entering in some of these expenses that we've been talking about. We're going to go and add in another $4,000 in advertising expenses. Then we're going to scroll down to our interest. We're going to say that some of this interest that we talked about today was deductible. We're going to have another $4,000 there. And we're really starting to chip away. It looks like we've gotten about $2,000 off of this amount due. And it should be noted that this is a live running solution. As I go through and enter in these values on the right-hand side, we're automatically getting a calculation. It's going to show us, is there an amount due? Is there a refund? It's going to be constantly calculating this AGI for us. So if we do make any errors, we're going to know pretty quick if we see a wild swing in variance. Moving forward from this, I actually want to go ahead and we're going to transition away from some of these gray areas that we've been talking about. And I want to get into vehicle expenses. And I want to go ahead and launch a poll question here. I want to ask you all, at your firm, do you typically do more actual expenses or are you using the mileage method? So we're going to go ahead. We're going to open up this poll. Maybe you're not doing any vehicle expenses. So that's probably pretty rare nowadays, but there are definitely two methods. And I'll let you know right now off the top of the bat before you answer, there's no correct answer on this. There are going to be certain situations where you want to take the actual expenses, and there's going to be certain situations where it's going to be better off to take the mileage. And I'm going to help you identify some of the key things that you need to look for in order to figure out when you should be using each expense method. So I'll give you all just a couple more seconds here. Go ahead, get your answers in, and then we can go over them in just a couple seconds. Okay. And do we have the results?
Yeah, so we got 75% saying mileage and 22% saying actual expenses.
And I think that makes perfect sense. Honestly, it's definitely easier to take the mileage, especially when you're running into customers that are not keeping clear and accurate mileage logs. So that matches what I would say, but there are going to be situations where the actual expense method is going to save you a bunch of money. And I'm actually going to go ahead and jump into TaxWise, and we're going to do a run through of what both of these methods look like. The actual expense method can be a little daunting at first, as it's going to be a lot of worksheets, but once you get the hang of it, it's really rather simple. It's really not as hard as it may seem. And how we're going to go ahead and do this is we're going to come to our car and truck expenses, line 9 right here. And we're going to notice within TaxWise, line 9 has a green bar underneath it. I'm kind of hovering my mouse right under it. That's going to let us know this is a calculated field, and this number needs to pull from multiple different worksheets. If I were to try to go in and hard key in information like I've done for advertising expense, it's going to let me know right off the bat this is pulling from different areas, and we need to go ahead and use those worksheets in order to do this accurately. How we're going to go and do that, there's a little gray arrow on the right-hand side of this field. When we go and click on it, we're going to have a button right here with a little chain. This is going to link us to the corresponding worksheets. And for this example, we actually need to go to the business vehicle worksheet. So let's go ahead and load that up. We're going to go ahead and make a description of Danny the plumber. He's going to have a large van. And to start this example off, what we first need to do is have a breakdown of business miles versus total miles. It is acceptable to use estimates here. However, if you ever do get audited by the IRS, having that mileage log is really a good piece of information in order to support how you're coming up with these figures. But for this example, we're going to say there was 10,000 miles of business, and then all the miles that were driven on this van over the course of the entire year were 20,000. And when we do that, we're going to get an automatic calculation here that 50% of these miles were for business. So when we go through the next part of this worksheet, we're going to start entering in some of the expenses associated with having a vehicle for your business. Let's go say he spent $4,000 in gas. He had to get 2 oil changes, which was $500. He had a tire blowout. It was $250 to replace. Some routine maintenance at $300. Insurance, $1,600. Then lastly, there was $300 in personal property taxes. And we can see as I'm going through and updating these items within this worksheet, automatically calculating the total for us. There's no need for us to go get our calculator out and retally this. It's going to be an automatic process. And then also, which is going to be an automatic process, is based off our business use percentage. That is going to be what is allowed to be deducted. So when we total up all of these items, we have just under $7,000. We have to chop that in half to $34.75. And when we actually go back to our Schedule C, we go to line 9, the car and truck expense. Look, these figures are automatically flowing through. If I were to go back into the vehicle worksheet and say all of these miles were business miles, we'll say all 20,000 were business miles. Well, I just have to update the one item. And then look, we have our percentage updating, we have our deductible amount updating. We go back to the first page of the Schedule C, we can now see that this is calculating based off of 100% of the miles. Now, one thing to make note of when you are using the actual method, on top of just the expenses that we talked about, the gas, the repairs, any insurance, property taxes, they're also going to get depreciation. And depreciation is going to be calculated on line 13. Depreciation in section 179 expense deduction. There's also a green field letting us know this is calculating. And we're going to go ahead and enter in some depreciation for this large van. So we're going to link to the worksheets here. And we are going to link to the depreciation worksheet, 4562. Going to load up. We're actually going to go to one more screen here. And it's going to be the asset worksheet. So when we go to the asset worksheet, we'll go ahead, we'll enter in a description of the property. And I should note while I'm doing this, you can probably see that there's some red bars underneath of the areas that I'm going. Well, these red bars are critical areas where if we have this worksheet, these items must be filled out in order for it to be accurate and accepted by the IRS when we e-file. It's going to take a lot of the guesswork out that you're not missing any critical fields. If I were to go make the date and service, we'll do it to keep it simple at the start of the year. When I tab over here, we can see the red bars are going away, and that's because these fields have now been entered into. When we scroll down, we're going to need to enter in the cost basis. In this case, we're going to use the amount that was paid for the van. We're going to say Danny the plumber paid $22,000 for this van. And we're going to have an automatic calculation once I enter that. Based off our depreciation, which is makers, and 5 years, it's letting us know automatically there's $4,400 of depreciation this year, and next year they're even going to get more. They're going to get over $7,000. And the reason that makers and 5 years are the selected amounts here, because up top I went and said this is an auto asset, and these are going to be standard, most common way I should say, in order to depreciate an auto asset. It's going to be 5 years using the makers method. However, it should be noted, and this is going to be an area of expertise that you can always add to your firm. There are some special depreciation allowances, and specifically when it comes to vehicles, any work vehicle that is over 6,000 pounds is going to be eligible for a special depreciation allowance. And using our Answer Connect package, which is our authoritative tax research, I've actually brought up an article about this deduction. And if we were to scroll up, the beginning of this is going to actually walk us through the deduction, who's eligible, and actually has a list here of all of the known vehicles that are over 6,000 pounds. Looks like we have a lot of trucks here, even have a Hummer, Jeeps, a very extensive list of all the different vehicles. And we're going to say for this example that Danny's van is over 6,000 pounds. And let me go back in the TaxWise here, is over 6,000 pounds. And he is going to be eligible for this special deduction. When I go and click the 100% button, an automatic calculation has taken place. As you can see, the depreciation up top has now been zeroed out. And down below, we're taking the entire basis of this deduction in this Schedule C. And another thing to note, let me go back and click no. Look at what happens to the refund amount. When I click no, he's still owing $3,600. But since we know about this special deduction, when I click the 100%, gone down to just $300 due. We've gotten this return down from $7,000 almost to a refunded amount. And if we were to go back into our Schedule C here, let me go back to the first page, and we scroll down to our depreciation, we can see that this deduction is automatically flowing through. So it's going to be important for you to know some of these different items that I'm talking about here today. It's going to be important to know about these special depreciation bonuses, is this is really how you can save your clients a ton of money. There is a very, very rewarding feeling when you have a client come in and they think they're going to owe a very substantial amount on your taxes. And this may be something that you already know about, but just being able to partake that information and pass it on to them, really help them out. That's where they're going to see value. We work in a field where our customers a lot of times there's a little misconception in how I view us. They view us as an investment. If I give you $300 to do my tax return, how much money are you going to save me? And that's how they view it. Technically, what we're trying to do is give them a very accurate IRS compatible tax return and getting it done correctly. But for better or worse, they're going to view us as an investment. Knowing some of these major deductions that they can take is really going to help minimize their taxable burden for this year and moving forward into future years. So with all that being said, I'm actually going to go ahead and I'm going to delete some of these items. I'm going to delete all these auto expenses that we just went and did. And we're going to go focus on the mileage. Now, the mileage method is going to be a little bit more simple. It's a little bit easier. It's a lot less work to do in order to go and calculate your deductions. So let me go back to the Schedule C here, and you can see that now the car and truck expense as well as depreciation, those have both been zeroed out. And how we're going to go and do the mileage method is we're going to go to the second page of our Schedule C. And let me go click on it. It's going to be part 4, information on your vehicle. And you're only going to complete this part if they are not filing out a depreciation for their business. And what you're going to do is you're going to come to line 43 here. When did you place the vehicle in service? We're going to keep it simple. We're going to keep it at this very start of the year. And then we're going to have to enter in our business miles. In this case, we'll stick with the 20,000. And then this is going to be and when we do that, it's going to have these red underlines here, letting us know these are some critical areas that we need to go ahead and fill out. Was your vehicle available for personal use? Just for this example, we're going to go ahead and say it was not available for personal use. Maybe there was a spouse or there was another vehicle that they could use when they weren't working. Your spouse have another vehicle? We're going to click yes. And then, do you have evidence to support your deduction? Now, this can be not so tricky, but can be an area where this is a very vague and wide open term. If your customers come up to you and they write on a piece of paper, I had 20,000 miles. That's all it says. I had 20,000 miles. But technically, you do have evidence, and technically it is written. I would definitely check these boxes. Yes, I do have evidence. And hey, they wrote it down. They gave it to me. Yes, this evidence is written. Now, this should come with a few caveats. Mainly being that if they get audited, is this going to hold up? It's probably going to depend on the agent that's auditing. If they want to be a stickler and they want to be real hard-nosed, this is probably not going to hold up. Some others may or may not, may allow it, but it's always worth having a conversation with your customers about keeping a mileage log. And I get it. A lot of your customers aren't going to want to do it. It's too much work. They're not going to want to go and have an Excel sheet, or if they do write everything down, they're not going to keep track. But this is really something that they should be doing. Highly recommend downloading some apps. I found that to have the greatest success rate, and them actually recording their miles. And the two that I always like to recommend are TripLog and MileIQ. I believe TripLog is free and MileIQ is extremely cheap. It's like $1. If they were to have that and just keep as much of that information as possible, you're going to have a lot more accurate records, and you're going to have two different kinds of customers. And you're probably going to know pretty quickly, are they the type that overestimates, or are they the type that underestimates? And having these accurate records are really going to help them out in the future if they do get audited. Now, continuing forward, with our mileage here. In order to get this calculation to compute within TaxWise, we can see they're going to get 56 cents a mile. All we have to do is check this box. And when we check this box, automatic calculation, we're going to see that we're going to get just over 11. Oh, looks like I only did 2,000. Let's change that up to 20,000 miles. When I do that, they're going to get quite a substantial deduction. They're getting 11,000 miles. However, you will notice that we've only gotten Danny's tax return down to about $3,600 due, whereas with the actual expense method, we had it all the way down to about $300. So you can see that there are some pros and cons. It's definitely easier to go ahead and just do the mileage method. You need less documentation, it takes less work, but you need to know about those specific situations in order to maximize. If you told Danny I was going to save you $3,300 because I know about this special deduction, I guarantee they're coming back to you next year. And not only that, you could probably charge them more money. They'll be so happy with you. And excuse me. So talking about when to know to use the two different methods, if they don't have a lot of expenses associated with their vehicle, if they just had, maybe they just reporting gas, they didn't have any work done on their car, they pay very little in insurance, it might actually be more beneficial to go and take the mileages. If we didn't have that special depreciation, that special bonus, it actually would have been more beneficial in this case to take the mileage over what the actual expenses were. So kind of knowing what you're looking for when trying to delineate between which one of these methods you're going to know, very, very important. And luckily in TaxWise, it's very easy for you to just quickly get both of them done. So with all of that being said, I'm going to jump back into our PowerPoint here. And I want to talk a little bit, first I want to go ahead and add a common question that I get is depreciation included in the mileage? And the answer to that is going to be yes. A part of that mileage rate is going to be depreciation. And we can see by this right-hand table here, mostly gone up over the years. We actually had a first dip in quite some time last year. But when they go and they need to go and sell that vehicle, you're going to have to keep in mind there is depreciation attached to that vehicle since this is a business asset. Common question. I know it doesn't come up too much, but I do want to make you aware that depreciation is going to be included in that mileage amount. You're not going to have to go fill out a depreciation worksheet. So with all of that being said, I actually want to spend a little bit of time here talking about our virtual tax office solutions. And today what we were using was TaxWise Online. Everything that we did was live. This is not a pre-recorded event. We did everything in real time. And some of the benefits of TaxWise is that this is going to be a product you can use anytime, anywhere. Whether you're on vacation or maybe you have some other side jobs that you do as well, we're going to have mobile capabilities. I have to travel all the time for this position that I'm in, and it's not uncommon for me to have to link up to a hotspot in order to use TaxWise. And what's nice is it's browser-based. You can access this from any device that has a browser, and you're not going to have to download it onto your computers, meaning as long as you know your login information, your username, and your password, you have any device available whatsoever, you're going to have the ability to see your client's tax returns. You're going to have the ability to work on them or look at the documentation that they've given you, that they've sent to you. It's all going to be right at your fingertips. And it's also going to be hosted on the cloud. And this is going to be important for a few reasons. As the cloud is specifically our servers, we use Microsoft Azure servers. These servers, along with Amazon servers, are by far the two most secure servers you could possibly have when hosting information on the cloud. And this is going to be important to you for a couple of reasons. Reason one is all of the sensitive financial information that your customers are sending to you. Ultimately, at the end of the day, you need to have safeguards in place to make sure that it is being stored in a safe area, an area that is not easily hacked or easily broken into. And it's also going to give your clients peace of mind, be able to say, look, maybe you're a little bit hesitant about having some of your financial information on the web, but we're using Microsoft servers. And the name that I always like to drop when talking about this is the FBI. When the FBI has to send confidential information back and forth online, they're using the same servers we do. They also use these Microsoft servers. So with all that being said, I do want to jump in and briefly take a quick look at Answer Connect. And Answer Connect, we briefly touched upon it while we were going through and looking at our truck example for trucks over $6,000. But this is a great tool that is available that integrates directly with TaxWise. And I can tell you, when I first graduated from school, I moved up to Washington, D.C. I was bright-eyed. I was very happy to start my career. It was a little overwhelming at first. What I learned in school and actually having clients that know more about your tax returns than you do, when you're new at least, having those conversations could be incredibly difficult. And the only tool that I had at my disposal in order to make sure that I was, using authoritative tax guidance, it was this big phone book. It's what it looked like. It was this big book. It was hundreds of pages. You'd have to flip through all the different items to get to the one paragraph that you needed. And it usually wouldn't go into that much depth. And your other option is going to be Google, which most tax preparers are not using Google, as it's not an authoritative place. Or if you get audited, you can say, well, Google said it. It does not work like that. You need to have a tool that's going to be authoritative. That is the main word. And if we were to jump into Answer Connect here, let me go ahead and bring up my browser. I've pulled up a few different articles here. It looks like while I was preparing for this, I was looking over some of the advertising expenses. And what's nice about Answer Connect is we can see who actually wrote the article, Caroline here. She's a JD, an LLM, not uncommon for these people to also be CPAs or MBAs. And they're writer analysis for Wolters Kluwer. And this is going to be important to you for a couple of reasons. Reason number one being, if you were to go back, like I was saying, and use Google, there are some issues with Google. You don't know exactly who wrote that article and if they are truly qualified. You may say they're an MBA, but has anyone properly vetted them? You don't really know. Also, even if you found an article where all of the information was correct in 2018, but now it is 2022, almost 2023, has the article been updated? Is this information still accurate? Maybe, maybe not. It's going to give you a lot of peace of mind to know that our Answer Connect tool here, this was developed with you in mind. We wanted to give you a tool where you could easily go through and know that you're looking at correct information. And what Caroline and the rest of this staff does is, as the tax law changes, and it changes every year, they will come in a timely manner, and they will come in and update these articles. This was a tool that I truly wish I had when I was first starting my career doing taxes, as it takes all of the guesswork out. And unlike that phone book that I had, which was just, a couple sentences per item, if we were to scroll down, it goes vastly in depth. It's highlighting the key word searches, in this case, advertising, giving its comments. Look at this example. We have a very detailed example that we can kind of follow as a template when trying to get through our tax return here. Also, important items to caution, items that we know that are causing issues as we're going through. As we're going through here, and let me go ahead. And I'm not sure if everyone can see, it looks like I have a comment here. If you can't see my screen, I'll just elaborate a little bit further. We're almost at the end of this presentation, so I'm not going to spend a lot of time going ahead and trying to get my screen up and running again. But we did want to launch one more polling question based off everything you've seen today. And let me go ahead and bring this up. And based off everything that you've learned today, we have a few different options. We can go ahead and launch that poll in the chat. But we'd like to know how you're feeling about TaxWise, if this is something that you would like to learn a little bit more about, if you're already a current customer. Would you like a little bit more information? Maybe you've already renewed with another tax software. Just let us know that as well. We want to make sure that these presentations are giving you the information that's going to be helpful to you, and we want to make sure that we're giving you all of the solution and all of the tools that you could possibly need in order to get through tax season, not only efficiently, but at the same time accurately. We want to make sure that these things are being done accurately. We'll give you just a couple seconds. The poll is open, and then we can go ahead and shut this down. And Omar, is there anything that you'd like to add as we end this presentation today?
Hey, Ryan, there was a few questions that were shared, but given that we only have 5 minutes, I wasn't sure if you wanted to answer them during the recording or if we should maybe follow up with those individuals individually to let them know. I think
Sure.
given that we don't have time, I think it may be best if you just follow up with those people individually. So if you submitted questions, we'll just go ahead and reply to those directly. In the future, we'll try to make a little bit more room for questions, but I know we're at time now. So I just, wanted to thank everybody for attending and thank you, Ryan, for presenting. And just to let you know that if you do select that you'd like more information, somebody will reach out to you from this question. And then beyond that, we will also be emailing you a recording of this session so that you have it readily available if you need to review it. We'll also be doing another similar virtual tax school webinar in December, so be on the lookout for that. And yeah, thank you very much for joining, and thank you again, Ryan, for presenting, and we look forward to seeing you in the future.
Absolutely. We wish you all the best of luck. Busy season is right around the corner. I've done quite a few. I know how stressful it can be trying to get so much work done in just a very condensed amount of time. But I'm sure you all will have great success. And I'm wishing you just the best busy season. And I hope you all learned a lot from this presentation today. Thank you very much.
Thank you, guys. Bye.